Now to spend a little bit of time on this non-recognition area. Just to say the obvious, because this course has very, very limited time, and we, of course, have a lot of area to cover, the part of 367 which we're focusing on is solely the outbound area in the context of, let's say, forming a subsidiary, transferring a branch to it, getting involved in a foreign joint venture, transferring assets to that. There's 367 covers a lot of other areas because there's, of course, many more types of tax-free transactions than just your normal transfer to a controlled corporation as found in Section 351. So we're looking at one narrow slice. There's a lot more out there. Okay, so the first obvious question is, of course, why are these rules there? Now, if you, of course, think about the fact that we've said over and over again throughout, this quarter that Congress, has sort of a religious belief that income, gain, value of U.S. persons cannot go untaxed. It's okay to delay it. It's okay to have deferral in certain situations. It's okay in all of those sorts of things to delay payment of tax. But it should never escape completely. Or alternatively, certain types of income should never be able to be transformed from ordinary to capital nature. Now, at various times in the past, of course, there have been much, much greater differences between the tax rate for ordinary income and capital gains. So a lot of the rules we have today, in a sense, we're focused on there being a significant difference. There's still a difference today in the individual side between capital gain and ordinary income. But on the corporate side, for the most part, same tax rate applies. But, of course, there are some other differences. Remember, ordinary income, if treated as a dividend, can carry a deemed paid tax credit. Ordinary income cannot be offset by capital loss carryforwards. Capital gains can be offset by capital loss carryforwards. So there can be some significant differences in the corporate sphere, but it's not the tax rate. So we have this need, this, like I say, religion of Congress, not to let anything get away. If you think in the large scheme of things, there's, let's say, 3 ways that property can leave the U.S. tax net. One way is by sale. Whether it's a table and share, whether it's intellectual property, whether it's any type of property, there could be a sale. There could also be a rental of property, or a license if we're talking about intellectual property, intangible property. So those 2 types are real taxable transactions. Real taxable transactions. There will be gain on the sale recognized by the transferor. There will be ordinary income as rental or license from a transfer for use as opposed to a transfer of all substantial rights. Now, Section 482, the transfer pricing rules, they cover related party transactions for sales and rentals or licenses. Those are covered. And that's why we talked about the WIN supply chain structure before talking about 367. Because 367 deals solely with non-recognition transactions. Again, I said there were, let's say, 3 types. They said sale, rental or license, and then what's the third? Third is some sort of transfer in exchange for shares, or transfer in exchange for securities, where securities are covered by some of these non-recognition provisions. So, and then as a corollary of this, transfer in exchange for shares, you have the concept of contribution to capital, which we'll talk a little bit more about in a few minutes. Now, Section 482 technically doesn't apply to any non-recognition transaction, because a non-recognition transaction is not itself a taxable event. Therefore, transfer pricing rules have no direct applicability. So any transfer of property outside the United States will have to be either, it will have to be one of those, let's say, 3 items: sale, rental or license, transfer in exchange for stock or securities, and including in that contributions to capital. The first 2 covered by Section 482. The last 2 covered by Section 367, in order to prevent, in the Congressional religion, to prevent assets, certain types of assets, from escaping U.S. taxation or being recharacterized to capital or something, in order to prevent any income or value being lost. So any transaction has to be in one of those 3 items. And that tells you, based on what that transaction is, which sections are going to be applicable. What would happen if there were no Section 367? So in the example, we have U.S. parent forms a newly wholly owned subsidiary, and I don't know whether you can see it from here, but that's a relatively complicated looking machine, which I think is meant to be some sort of petrochemical facility, but I wouldn't stake my life on it. It was a good picture, which I found for the purpose. In any case, if the U.S. parent transfers this to the foreign company, to the, in this case, which is a CFC, Controlled Foreign Corporation, if it does, and transfers it in exchange for shares, and if we say that there's a tax basis of 200 and a fair market value of 300, then we've transferred 100 of, in a sense, value, or 100 of gain outside of the United States. Now again, we're saying no Section 367 because under the 351, transfer to controlled corporation rule, transfer of a machine by an 80 or greater % owner is a non-recognized, non-recognition transaction. So we look at the various rules. The CFC takes a carryover basis, which of course is consistent with the tax-free transfer. And the CFC, if it later either, if the CFC sells that machine for 300 to some third party, we have 100 of gain recognized inside the CFC. And if this is a business asset, if it's sold to somebody in the same country of incorporation, there's no subpart F income, there's no foreign-based company sales income. And as a result, the gain is given full deferral, and there will be no U.S. tax on that gain until sometime in the indefinite future when the earnings are distributed back. And I think, as you all, of course, know, because we've repeated it a number of times during the quarter, there's pressure, so to speak, that's such that there's continuing discussions as to whether there should be another holiday, so to speak, that will allow low-taxed overseas earnings to be brought back at a very low tax cost. So until anything is brought back, deferral, and possibly able to bring it back at a lower tax rate, a lower rate if there's another holiday. Okay, so this example, 100% owned CFC, and we're talking about a machine. Now, in this example, again, assuming there's no 367, we're assuming a foreign joint venture. So that there's the U.S. joint venture partner and the foreign joint venture partner. They both put assets into the new company, which is formed in some location in the world outside the United States. U.S. side puts in intellectual property, which has a basis of 0, but a value of 1,000. The foreign joint venture partner puts in plant and equipment. And let's assume that the basis and fair market value is the same. So again, this is a 351 transaction. Persons, even though they're not related, are both transferring assets into a company. They together own 80% or more. You have a valid 351 transaction. Now, because of the 50-50 ownership split, needless to say, this is not a CFC, not a controlled foreign corporation. And as a result, that means there can be no subpart F income. There's full deferral until such time as distributions are made. And there's capital gain if the 50% ownership interest is sold. So again, this is something that that Congress is concerned about, because all of this value, the crown jewels, especially of intangibles, are going overseas, and they will result in earnings inside that foreign joint venture company which are not able to be, or which will be realized outside of the U.S. tax net. What's the mechanism that we find in Section 367A? we get this sort of strange language that says, if you have a transfer or an exchange under these various sections, 351 one of them, then such foreign corporation shall not be considered to be a corporation. Where'd this strange language come from? Because it's not saying, if this rule applies, then it will be taxable. So, as to why they didn't say that, frankly, I've never thought about it. But what they did say is this, and what the mechanism is that if you look in all of your non-recognition sections, for the non-recognition sections to apply, the foreign company has to be a corporation. If it's not a corporation, then the non-recognition section, by definition, does not apply. So I've never, like I say, thought about, well, why didn't they just say it directly? But this is what they said, and this is what it means. Now, I mentioned about contributions to capital. Now, the obvious first question is, what is a contribution to capital? And a contribution to capital is pretty much any situation where a shareholder is transferring property to a corporation for a price that is less than fair market value. Now, that price might be paid in cash or other property, or perhaps in securities, which in fact have a recognizable value in relation to other shareholders that causes the recipient to receive less value than he transferred. But the most common situation is just a shareholder transferring assets to a corporation and just not receiving any consideration at all. Now, we'll talk about this more in the next course, in next quarter, but if you think about a contribution to capital, on the other side, the foreign company's receiving something and not paying for it. There's the issue on the foreign side of, well, is that receipt, is that income? And in a lot of countries, a contribution to capital in the, for the corporation which receives it can be income that's taxable in that location. But again, that's for next quarter. From the U.S. side, if we look at it, we see that there's various sections which tell us what to do with contributions to capital. We have 118, which tells us that the corporation which receives it, assuming that it's a U.S. corporate recipient of the contribution, that will normally not be income. We have 362, which gives basis rules, which says that the recipient corporation will get a carryover basis from the transferor. And we, of course, end up seeing in the outbound context, we see a specific rule in 367, which very interestingly is labeled for purposes of this chapter. What chapter are we talking about? Is this, chapter 22 of Lord of the Rings we're talking about? Any idea what chapter, starts at starts at section 1? Chapter 1, yes. Chapter 1 starts at Section 1 and I think goes up through roughly 1400. So, you know, that's a pretty broad swath of our income tax. So this is applicable not just for 367 concerns, but also for the rest of the income tax rules as well, as to how to treat a contribution to capital where the contributing person or persons own 80% or more. So it's treated like a 351 contribution, which again is a non-recognition transaction. If you had only one shareholder that transfers, let's say one shareholder that owns 50%, that one shareholder transfers an asset for no consideration. It's still a contribution to capital, but it's not going to be under this 367C2 rule. It's just a contribution to capital. Now, it's kind of interesting. There's also in 367 a subsection F, which gives a rule which says in that kind of case, to the extent provided in regulations, this kind of contribution to capital will be treated as if it were an exchange for fair market value, for value equal to fair market value of the property transferred. In other words, a taxable transaction. But interestingly enough, as of today, there's no regulations. And if I remember correctly, I think this was brought in sometime in the 90s when this subsection was added. So today it's effectively not effective, but it may come in at some point. We said that 367A1 specifically says, through this somewhat convoluted language, that you're going to have taxability on transfer of appreciated property to a foreign corporation. But what about losses? What if you have a built-in loss? The examples we were looking at, you know, when we said what if 367 did not exist, we assumed that the value, the fair market value, was more than the basis, so that there was gain. But what about loss? You can have plenty of situations where the fair market value is less than the basis, the tax basis. That could happen with machinery. That could happen with inventory. That could happen with any sort of property. So what happens there? Now, interestingly, 367 only applies to make gains that would otherwise be tax-free, to make gains taxable. It does not change the Section 351 transfer to controlled corporation, non-recognition of gain or loss. It doesn't change anything for an asset that is below its basis, that has a value below its basis. So you still have non-recognition of losses. And the regulations take a very, very harsh view that you do this on an asset-by-asset basis. One asset gets transferred, it has appreciation. It's treated one way, and you get tax on it. Another asset has a loss, which maybe economically offsets, but you do not recognize the loss. So this situation where you can have gains on one asset, losses on another, they don't offset. You've got to look asset by asset. Did you want to say something, Christine?
So to the extent that the aggregate losses? Is it aggregate as to that asset, so you always get the basis of tone?
If I remember correctly, I think your 362E rules on, okay, what Christine is bringing up is that there's some rules under 360, or let's go back a step. The general rule under 362 is that there's a carryover basis in the hands of the transferee corporation when the asset is transferred to the corporation. There's a carryover basis. 367E is, which we have a slide on at some point. Oh, yeah, right here. 362E specifically is trying to avoid a taxpayer getting a double benefit. Now, what do I mean by that? U.S. company, foreign corporation. If we transfer in exchange for shares, let's say an asset which has a basis of 100, but a fair market value of 60, there's 40 of loss. There's 40 of economic loss. But, of course, because 351 still applies, the tax-free, no recognition of gain or loss on transfer to controlled corporation, because that still applies for losses, because, again, 367A1 only applies to gain. So we have a non-recognition of the 40 of loss, and now we have, under the normal rule, we have a carryover basis of 100 within the corporation here, because the usual rule would be a carryover basis down here, so the foreign corporation would have that basis. Now, notice that if the U.S. company were to sell the shares, because it gets a substituted basis for the shares in the foreign corporation, that's your 358 rule. If it sells the shares, it realizes economically 40 of loss. Inside the foreign corporation, if the foreign corporation sells this asset to some third party for 60, then that foreign corporation will have 40 of loss. So there's two possible transactions, one for the U.S. company and one for the foreign corporation, where a loss will be realized. Now, I think you can imagine that, again, from the basic religion of Congress, granting somebody economically a loss twice is not something which, has attraction for Congress. So what 367E does is it says, in this kind of situation, we will not allow that 100 of basis. Rather, the basis in the foreign corporation can only be 60, in other words, the lesser of the basis or fair market value. Now, to confuse things further, there's also an election there which allows a taxpayer to reverse this and have the 100 here and then have the 60 basis in the shares instead of the 100 basis. There's an election for that. Now, the next couple of slides, which I will not go through, goes through a bit of this same computation, to give an idea of how this works. Now, Christine's original question was actually not this exactly, but rather, do you group transactions? And as I recall, there is some, yes, grouping of transactions under that, but I don't remember specifically. But this is what it's trying to get at, to avoid a double benefit. Now, you might look at this and say, well, gee, is there in fact a double benefit? If we didn't have this special rule in 362E? This is a foreign corporation. It's not directly subject to U.S. tax, unless it has effectively connected income or U.S. source income. Well, remember, that foreign corporation, it's got, the U.S. people are concerned about the earnings and profits of that foreign corporation. And how the earnings and profits are calculated may or may not immediately, but at some point will directly affect the taxation of the U.S. person. So yes, there could be a double benefit, and this rule is trying to prevent it. Let's say a few words now about the major exception to this broad 367A1 rule that any non-recognition section will not apply for property transferred at a gain. This exception is essentially saying that there will be tax-free treatment. In other words, 367A1 will not apply, and the original non-recognition section will apply if the transfer is of property to be used in an active trade or business. And as you might expect, because this is granting an exception to the general rule, the standards of is there an active trade or business are relatively high. And there's a bunch of regulations which give you guidance in seeing whether or not there's enough activity to have this active trade or business. I suppose I could have layers of exceptions. The general rule is your non-recognition section. Then there's the exception for 367A1. Then there's the exception for active trade or business. And now there's an exception to that, which is very, very important. And that is that even if certain assets are transferred to an active trade or business, tax will still have to be paid. And frankly, these particular items which are listed up there, which of course are found in the law itself, these items are your most valuable items in the transfer of any business. Inventory, installment receivables where there hasn't been any gain recognized yet because of an installment basis, intangible property, and so on. I mean, these are the more important items. So this is sort of the exception, the exception, the exception, and so on. If I say that these are the items which are covered by the exception, well, what's left? That's sort of an obvious question. Well, what's left? What can actually receive non-recognition because it's transferred to an active trader business and doesn't get knocked out, so to speak, by these several categories. And the items are essentially these fixed assets, but of course depreciation recapture can still apply. Various local currency denominated assets. So for example, accounts receivable where the income has already been accrued. In other words, not an installment. Receivable where the income hasn't been accrued, or a cash basis taxpayer who hasn't recognized the income from the sale yet. Those would not be covered. Prepaid rent, security deposits, things like that. Things like office supplies and whatnot, pens and paper, paper clips, and so on. In other words, items which are not included in normal inventory of the company. And then the last one, which obviously is extremely important, is goodwill and going concern value. So as a practical matter, I think that's the most important one which is there. Obviously, fixed assets can be very material, but the number of times fixed assets have a significantly higher value than their tax basis, maybe that doesn't arise quite so often. It can, but it's not normally so much of an issue. Now, we said that one of the exceptions, of course, was for intangibles. So a definition for intangibles becomes very, very important. And the definition, there's a reference to what you may look at and say is a somewhat obscure section, which is in what's called the Possessions Corporation Rules, which were focused primarily at Puerto Rico. So this is just where the definition comes from. And it's very broad and covers pretty much everything that you can imagine aside from goodwill and going concern value. So very broad with respect to intellectual property. The regulations use a term which has limited applicability, but you see the term and you scratch your head and say, gee, why is it there? And that's this operating intangibles, which is primarily, for example, long-term purchase or supply contracts, things like that. There's a particular rule, later on, which uses this, and we'll mention it briefly, but I put it up here more from the standpoint that if you see the term, you may have trouble finding where it's relevant, without reading 50 pages of regulations. So this tries to give you the place to look for that. Now, specifically, what is not included in that definition of intangibles? There's two items. The lower one, of course, is the goodwill or going concern value that we keep talking about. The upper one is, again, a special one regarding copyrights, literary, musical compositions, personally created by the taxpayer. And interestingly, these things are treated like inventory and therefore are taxable no matter what, even though transferred to an active trader business. Without going into too much too much detail on this. I think, again, getting back to what I will call the religious element of Congress in terms of not wanting to see the U.S. Treasury cheated out of something. There's real overkill here because there's 3 places throughout the tax law that deals with the use of losses that have something to do with activities outside the United States. And this one, of course, is if the branch, which is being operated, say, in Japan, as one of the cases was, if that branch is transferred to a corporation, if that branch has had losses that have offset U.S. income, in other words, there's losses through the activities of the branch in Japan, and it offsets income that's from operations inside the United States. Well, if you transfer those activities, that business, to a new company, and then it becomes profitable, the earnings are going to be, of course, outside the U.S. tax net. So you've allowed a tax benefit inside the United States, but then when those losses are recouped from future earnings from the same economic activity, they're outside the U.S. taxing net. So that's a problem from the U.S. viewpoint. So you've got these 3 rules, one being in the 367 area, and these are very convoluted rules, which I've given you some background in the slides, but we won't go through in here. Just understand the concept that the U.S. wants a recapture of these losses, and to not allow them to have future income, in a sense, which escapes U.S. taxation where the losses were used in the United States. So they don't want this kind of situation. The other couple of areas where you find this, there's the overall foreign loss rules that we mentioned that were in the foreign tax credit rules. Now, interestingly, this is in the foreign tax credit rules, but this 904F3 specifically covers, or let's say creates, a recapture that causes income that has nothing to do with the foreign tax credit. So again, there can be a recapture in that instance. The third one, the dual consolidated loss rules, what a lot of companies were doing was to, for example, have a U.S. company, let's say U.S.-based group, owning a UK company that's going to have operations. And the financing of those assets and activities that are going to be in the UK is done through a U.S. company which is managed and controlled in the UK. So it becomes a dual resident company and is able to claim the interest deduction in the UK and in the US. So again, the thought being that it's not right for the same expense to be claimed and taken a benefit in 2 different countries. There's some complicated rules regarding this. So again, understand that this area of losses, foreign losses that are used against U.S. income, whenever you see that, that should be a flag saying, gee, maybe I need to think about this, whether it's the 367 rules, the 904F3, or the dual consolidated loss rules. We'll talk a little bit about 367D before we go on to the next topic. 367D is the section dealing specifically with intangibles. And as I try to set out in the slides, the statutory construction is a little bit convoluted. You know, on the one hand, you've got section 367A that says one thing, and then 367D, for the most part, overrides what's in 367A, unless you have this previously deducted branch losses. So again, without going into any detail on that, hopefully these will be helpful to you at some time in the future when you are looking through 367 and trying to get to know it better. Why are those rules needed? Why is 367 needed? Well, there's really three important reasons. There's a lot of benefit from a tax perspective of doing research in the United States. Immediate deductibility of R&D expenses. Well, you know, you might think, well, you know, why is that such a benefit? Well, if you were building this table, you'd have to capitalize the cost and then depreciate it over 5 years or 10 years or 15 years. You don't have to do that with R&D, with intangibles that you're trying to self-create. You expense it. So that is a major benefit, especially as you think about pharmaceutical industries, high-tech industries that are spending so much on R&D and creating intangibles, which, yes, has major value. So that is important. The second thing, obviously, is that there's an R&D tax credit. Yes, Lynn?
So do other countries compete for R&D, or specific countries target that type?
Oh, absolutely. Last time I looked, there were 35 countries that had R&D tax credits. It may be higher now. If you're interested, for example, in this kind of thing, the OECD keeps statistics on this kind of stuff.
Canada has a huge one. They have like 1.42 cents for every dollar on tax credit.
Yeah, Canada has been at the forefront of this. And in fact, some of the technology, in the sense of how to have a foreign tax credit, has been disseminated from Canada to other countries. So yeah, Canada has been really at the forefront of this. So between immediate deductibility and the tax credit, this is a real benefit. And yes, in a sense, other countries, a lot of other countries use, will have an R&D credit and deductibility in their laws to encourage investors to bring R&D activities into their countries. There are some benefits, for example, that are surviving in this area in China. Despite what I had mentioned earlier was this basic philosophy that, hey, we don't need to give tax benefits in order to get investors here. But for R&D, yeah, there's still some stuff available. Okay, second point is that obviously the ability to transfer U.S. developed IP to a foreign corporation and then have it, the value really realized in the future, that's a concern, because in the absence of 367, you could just transfer these valuable intellectual properties overseas. And then the third one, which is why do we have the particular structure we find? We've been talking ad nauseum over the past few weeks about how difficult it is to value intangibles. So instead of valuing intangibles, today at the moment of transfer, this says ignore that and value it based on use over the next 20 years. A very pragmatic approach to ignore what is really difficult to value today and use hindsight, in a sense, each year in the future for 20 years to come up with an amount. So this is why we have these special rules. Now, what roughly are these rules? Okay, transferor treated as having sold the intangibles for annual payments contingent upon productivity, use, or disposition. So essentially, we're saying economically, you're not going to sell it for a lump sum, even though you might be able to come up with an arguably true fair market value of the date of transfer. You're going to treat it as if you licensed it and have a series of royalty payments. That's the mechanism. Interestingly, notice the note about the Obama 2012 revenue proposals. One of the proposals is to add to this goodwill and going concern value, so that goodwill and going concern value would be taken out of the protection they presently have under the active business exception in 367A, and they would be moved into 367D, and there would need to be a future annual payment in regard to that. Obviously, as of today, no idea whether this would be, enacted or not, but it's specifically a proposal. The point I would like to make here, irrespective of what's exactly on the slide, which is more focused at, well, how do you calculate it? This is termed in the statute an annual payment. But is there any payment? If we have this situation of the U.S. parent, transfers intangibles to, let's say it is a CFC, but that really doesn't matter for this purpose. If we say that we have a transfer which is subject to this 367D rule, so that there's this annual payment which is economically like a royalty, is there any actual payment? Is there any actual payment? If there are two human beings, now absent my having donative intent, am I going to take some money out of my pocket and pass it over here to Kristen? You look.
Why not?
You look very expectant. I'll put it back in and squander it in some other fashion. But am I going to do that? Well, probably not. Unless I have real donative intent, as a human being can have, I'm not going to do so. Well, what about two corporations? The two corporations, give each other, make payments from one to the other, just gratuitously without some sort of document or statutory or other legal ability and reason to do so? No, they don't. A shareholder, yes, can transfer assets and property to a corporation, but in that case, there's some increase in value for the shareholder because, he has a continuing ownership interest in the corporation to which he has transferred the property. So there's, some logic to that. But what about a case where in 367D it says there's going to be an annual payment, but there's no basis on which to physically have the CFC pay anything to the U.S. shareholder? There's no legal ability to make the payment. So in this kind of situation, the statute calls it a payment, but it's going to be the rare situation where a payment can actually be made. So, we know that generally throughout the tax code, there's good accounting principles apply. Now, gee, what are good accounting principles? Good accounting principles are things like, if I pay for something, I have a cost basis. If I have a tax-free exchange, I have a carryover basis. If I have taxable income, I have an increase in basis, for example, in a non-recognition transaction where I also happen to have some taxable portion of it, liabilities in excess of basis, or who knows what it is. But if I have some taxability, I get additional basis for the amount of taxable income I have. So the numbers are supposed to work out. Well, how does this work out if our situation is that the U.S. is treated as having received a payment, but except in rare situations, there's going to be no ability for the CFC to make the payment? Okay, what the regulations do is the following. They say, number one, and this is in the statute itself, number one, the CFC has a reduction in its earnings and profits for the amount of the payment. So we have a reduction in E&P. Number two, of course, we have taxable income. Taxable income at the U.S. Company level. And because this is termed a payment, which hasn't been made yet, of course, the regulations tell us that that creates an account receivable. Now, for those of you who have a little bit of, let's say, bookkeeping background, you know that, when a company makes a sale, on credit, it debits accounts receivable and credits sales. Pretty simple stuff. Well, that's exactly what's happening here. We debit accounts receivable, we credit royalty income. Well, technically it's not a royalty, it's an annual payment, but we credit income. Well, now, from a tax balance sheet point of view, we have this account receivable. So the the regulation says that if the CFC here makes payment of that account receivable, then that's fine. It'll be payment of the account receivable, and that's the end of it. So the money can be received, in a sense, free. There's an account receivable. There's no tax effect from payment. But the usual situation is that there will be no payment. So the result is that the regulations say if there's no payment, then what you will do is after 3 years, you will write off that account receivable and, in a sense, transfer that amount and increase your basis in the shares of the CFC. So the accounting, so to speak, works out. There's a reduction in E&P here, there's income here, but since no cash is received, ultimately the basis in the shares are increased by the amount of income that has not been received in cash. Yes.
Question. I would like to be sure. So the USA parent doesn't pay any taxes unless he received payment, right?
No.
Or he's liable for taxes on the deemed payment.
Yeah, he's liable for tax on the deemed payment, exactly. In a sense, again, as you get more comfortable with, in a sense, I'll just call it the bookkeeping aspects of recognition of taxable income, basis, the carryover basis or substituted basis rules. They're all consistent to make sure that nothing gets lost or there's no inconsistencies between them. Again, if you have a tax-free exchange, you expect to see carryover or substituted basis. If I buy a cup of coffee, I have a basis in that cup of coffee which is equal to my cost. Well, I may expense it immediately, but the amount of expense is my cost. If I transfer under 351 to a controlled corporation an asset and there's appreciation, and if I have to recognize some amount of that appreciation under some rule, whether it's 367 or some other rule, your various basis rules, 358, 362, they give you benefit for the taxable income that you recognize. So there's consistency. So yes, in this case of 367D, you have, for the U.S. Shareholder, you have recognition of income, you have creation of an account receivable in which you have tax basis because you recognized the income on that annual payment as it's termed. But then, to the extent you haven't received payment after 3 years, you move this good tax basis you have in the account receivable and you treat it as a contribution to capital, and now you have additional basis in your shares. So the numbers work out. And these are, let's say, areas which are difficult to explain, but over time, as you see them more often, you'll start to get a sense of how these things work together.